Welcome back. So here we are, a pretty anticipated video by a lot of people because you see every day I'm trading and breaking down the market through power of three. All right. And there's a much simpler way to break down and understand power of three, and that is through open, high, low, close, or the opposite, open, low, high, close. Okay, it can go in no other order, and I'm going to be breaking that down here so you can understand where we are inside the lower time frame within that higher time frame candle breakdown. Okay, it's going to bring you so much more logic and precision to your trading and analysis. So let's get into it. So why is this important? Every candle has an open, a high, a low, and a close. This is important because it can only go one of two ways. These are the only two orders a candle can form. You always have your open, and then from there it's going to form the high or low depending on if it's a bearish or bullish candle. So for instance, number one here, this sequence would be for a bearish candle. Okay, we have the open, we move up, create the high, and then we move back down, create the low, and then we retrace up a little bit to close. That is a bearish candle. And then the opposite, when bullish, you have your opening price, we move below it, and then we move up, create the high of the candle, and then we come back down and close the candle. Okay, so this alone, it's very vague and needs more framework. This is where the standard deviation and SMT will come into play, because this is how you can confirm your highs and lows for safe stops and targets, as well as confirm the end and beginning of phases, whether that's the end of the accumulation phase and we're entering the manipulation phase, or almost the opposite. We're ending the manipulation phase and entering the distribution phase. Okay. So many ways to break this down and understand and trade inside of it. So here I have just a rough example of what we're going to be looking at before we get into the charts. So right here on the left, I have the higher time frame candle, and this can really vary based on the lower time frame and how low you're going. Because if you're trading a 1 minute chart, a 15-minute candle could be your higher time frame candle if you're trading that. Or there's many people that trade 1 hour power of three. All right. Me specifically, I like to stay on the 5 and 15-minute chart and break down 4 hour and daily candles. And then obviously we're breaking those down from the weekly and monthly candles, but that's if you want to get a way deeper understanding of what is actually happening within price, and also having that time frame alignment from yearly to monthly and so on and so forth. But this is what we're going to be looking at here. So this is an example of open, high, low, close. Okay, so this is a bearish candle. We had the opening price of this candle here. We went up, we created the high, and then price went down, created the low, and then we retrace up and closed. Okay, so this is what it would look like roughly on the lower time frame. So you're gonna have the opening of the candle, and typically around here is where you'll see the accumulation within the candle. So you'll see price sit here, accumulate, just fiddle around, not doing a whole lot, and that is what we're trying to avoid. We want to avoid the times of uncertainty and when we're not moving, when we're in that accumulation phase. So be watching for that, study it, and break that down, because when you can learn to avoid the accumulation, you're going to be missing out on a lot of potential losses. Okay, and saving yourself a lot of stress, not trying to hold a position through accumulation when we're just sitting there chopping around, not doing anything. So sat here, accumulated, and then boom, right here's the manipulation. They move up above the opening price, and we create the high of the candle. And on the lower time frame, there is going to be candles moving up here to create this high, but on the higher time frame candle, this is still going to be a wick. Okay, lower time frame candles can be a higher time frame wick. which is the manipulation in a bearish candle. Because ideally, if you are bearish, you are trying to get your short position inside of the higher time frame wick, okay? Because if you can get a short entry up in here, you are safe and risk-free for the ride down to our standard deviation projections and the drawn liquidity. So as I said, here was the manipulation. They take it up and then distribution to the downside. So accumulation, manipulation, distribution. Okay, that's your AMD within your power of 3. And that is what we're looking for to break it down much more simply. And it's not always going to occur that smooth or that obvious, okay? There's going to be times of accumulation where you'll see it be in a trend to the downside or to the upside, just slowly dragging along. And that's no different. That is accumulation. Watch for the manipulation and look to play the distribution. So as I was saying, this top wick here on our higher time frame candle is the manipulation of that candle, or within that time frame, that was the manipulation, and that is where you're trying to position yourselves. And a good rule to help you do this is by, when bearish, only short or sell above the opening price. Okay, and then the opposite when bullish. When you're bullish, only look for longs below that opening price. And that doesn't mean if you're bearish and you missed out on the short that you're longing because of it. No, you wait for the next setup. You missed that setup. You missed your opportunity. Okay, be patient. Be picky with the setups you're taking. So what other tools do you need? You need the standard deviation and SMT. If you have not watched my other video on standard deviation plus SMT theory, I recommend doing so, because I go over these two concepts the most in that video, because this is my theory. Every price reversal, every return to fair value, pretty much every move in the market is explained by the standard deviation and SMT. Okay, and once again, if you want to go look further into that, go watch my other video. But those are the two concepts and tools that you're going to need to break down power of 3. So the market moves in deviations of manipulation moves based on the manipulation move and how far it expands. So if I go back one candle here, I'm going to be showing you more examples, and we're going to get into the charts, obviously, but you want to have an understanding of what's happening first. And this manipulation move above the opening price, you can put the standard deviation from this high to this low and project to the downside. And the low that forms here will be within our key spot within the standard deviation, whether that's 2 to 2.5 standard deviations or 3.5 to 4. It depends on the framework and all of that other good stuff and how far or how long the manipulation occurs for. Okay, so let's get back over here. So now think in terms of 1, 2, 3, 4. Okay, it isn't always going to be this clean, clear cut and simple, don't get me wrong, but thinking in terms of 1, 2, 3, 4 like this is going to help you a lot, especially in the beginning, understanding and getting the framework for this down, just to understand the logic better and how it works. Because once again, looking here at a bearish candle, so it goes in the order of open, high, low, close. So open, that's your first, that's number 1. The high is number 2. The low is number 3, and then the close is number 4. This is the end of the power of 3. That's the end of the candle. So here's we break down the lower time frame. You have 1, the opening price. What do? They accumulate it, and then boom, they give the manipulation, which creates what? The high of the candle, number 2. So then from there, we have our standard deviation projection down. They give our reaccumulation at 2 to 2.5. Give that false market structure shift back to the upside, get people thinking it's bullish, and then boom, right down into 3.5 to 4 standard deviations where we create the low, which is number 3. Okay, and from there we move up and close the candle. Okay, and why do we see this move up here at the end? And that is because they want to create the wick of that candle. So looking back over here at the higher time frame, for us to create the low here and to close the candle here to create this wick, there needs to be a move on the lower time frame below like this. So we move down, we create the low, and then we get that retrace back up and then close the candle, because that is making this move here the wick of this higher time frame candle, the bottom wick. Okay, so there it is, our 1, 2, 3, 4. So keep that in mind as we're going through the chart examples and more, just so that it's easier to understand, especially when you're starting out. If you're not familiar with power of three or breaking the market down in this extent, then yes, I recommend doing this. If you already have a great or greater understanding of power of three and what is happening, this is likely not needed, okay? But once again, it's going to help a lot as we get into the chart examples here. All right, so here as we start in the charts, I'm actually going to be starting with a weekly power of three example and breaking down a weekly candle down to the 4-hour chart and under, and just how I would guide through the week and understand it within that power of three breakdown. And another thing, I like to use these recent examples in price that just happened because it gives more understanding to the people watching, because you likely watched this price play out as well. And if you were wrong, then you're able to understand what you thought and why, and how you could change that or understand it differently from what you were thinking. Okay. And that's also why I'm saying, as we get out of this yearly accumulation phase, because you can see here since the yearly open, we've just been in straight accumulation. Once we get out of this yearly accumulation phase, you will start seeing a lot more content from me and giving you more logic to price reading, because trust me, we're just getting started this year. I have a lot planned for this year. And once again, we're here. We're going to break down weekly power of three first. We're going to get down into the lower time frames as well. Don't get me wrong. But this right here is going to start your framework for the week. Okay, and this is what you should be doing every week. So in specifics, we're going to be focusing and looking at these 2 weeks here, where we had two pretty big gap downs into the Sunday opening, the new week, and you had everyone bearish at the lows. And I'm just going to be explaining here how I used open, high, low, close into understanding the low was forming there when everyone was bearish. Okay, so as we go into a power of three, that power of three is always going to be reacting and playing off of that previous power of three. So I'm going to be marking out some swings here. I was using our projections, and if you want more understanding or logic to why I'm using certain projections or projecting this or that, go watch some of my other videos. That's not what I'm here to explain today, because that needs a whole video in itself. So if you want to see that, go check that out and or join my Discord. I'm answering questions about it all day, every day. So once again, we're seeing this swing here. We had from all-time highs, we hit 3.5 to 4 standard deviations down here. So what typically happens at 3.5 to 4 standard deviations? That is typically where we see the range cap. Okay, so while everyone was bearish down here at 3.5 to 4 standard deviations, they see us breaking the equal lows, the double bottom, the big support here. So the world's ending, we're just going to be free falling after that, when really it's the opposite. Everyone that bought this breakout to the downside got faked out, and yeah, that was the end of the story. So we're always playing off of a previous power of three and a previous swing. So from here, once we hit our 3.5 to 4 standard deviations to the downside, we had our swing to use back to the upside, okay? And not every swing's 3.5 to 4 standard deviations will be hit, okay? There's logic for reversals at 2 to 2.5 as well. And right here, so this is the example I'm going to be getting into. Over here, we had our weekly open right here. I'm getting into this week, but before we get in and start breaking that down, we need to know where we were at based on our previous power of three within our standard deviation and that good stuff. So here we notice we're hitting our 2 to 2.5 standard deviations as they're going into the end of the week. So Friday, they give the displacement down to this low, and the gap down is what gave it through the low. All right, right there. That is what confirmed this new high for me, because let me zoom out here and show you the ES. So right here, at this time, the ES went up and made a new higher high. So the ES was still making higher highs on this move up. The NQ was coming up short. So Wednesday was that high of day that week. So right here was the SMT. SMT works when it's at our key spot within the standard deviation, and we met our draw on liquidity. So right here we have our SMT. This is very important because this is what confirmed this high to me up here. So now let's look right back into the NASDAQ chart. So SMT, key spot within the standard deviation, displacement below this low, another valid projection back to the downside. Okay. And here, this is when I had the idea, okay, I wanted to see this downside move going into the week. And right off the weekly open, they gave the, what was it? It was the DeepSeek bearish news. Everyone and their mom was bearish, okay? I mean, everyone. My whole feed on Twitter, I couldn't scroll 3 posts without seeing a bearish post about the NASDAQ. And right away, that was already getting me bullish. Whenever I'm seeing everyone else post the same thing, typically when everyone is thinking the same thing, things don't end well. So here they are. They move it aggressively, 1,000 points to the downside, straight to where? 3.5 to 4 standard deviations. Okay. And this right here alone is proof of an algorithm. Okay. Because there's no way anyone is going to tell me and be able to say it with a straight face that DeepSeek bearish news causes a 1,000-point sell-off, and then right here at 3.5 to 4 standard deviations, sellers just stop selling and buyers step in, and that's what moves price back to the upside here? No, that is not at all what moves price. Okay, it does move price to an extent, buyers and sellers do, because there needs to be liquidity in the market, but it's not how everyone thinks. So once again, we move down, key spot within the standard deviation, 3.5 to 4. So let's think in terms of 1, 2, 3, 4 again. Right here, we had our open, that's our 1. We had our low now, which is 2. Why do we anticipate this to be the low? The standard deviation is telling us we're seeing 3.5 to 4 standard deviations hit. We're seeing SMT here. And another thing, our weekly open. So in this case, we had not seen a wick on the top part of this weekly candle yet. So at this time, when we're looking down here at the lows, the current weekly candle looked like this. All right, so after we got a little retrace here up off the lows, this is what this current weekly candle was looking like. A big red candle, no wick above and a wick below. So right there, that was already indication to me that we were going to go back up that week, because it's very low probability to see a candle leave no wick on one side. And just right away, you can go back here in the charts and just look at how many times a candle leaves no wick. It's not often. And the times it does, you're going to see price use it as a magnet to come back to. So you can see here, we left no wick. We traded down. We hit our 3.5 to 4 standard deviations, and then boom, right back up to that level. And then once again, this moved to the upside. We left one candle here without a wick. Look at this. We hit our key spot within the standard deviation, SMT, boom, right back down to it. And once again, that was also a level that lined up here inside 3.5 to 4 standard deviations. So this one was an even higher probability target. So from there, I'm thinking in terms of 1, 2, 3, 4. We formed our open. We have the low now. We're hitting our standard deviation. We have SMT. We're below every time opening we could have. our yearly, monthly, weekly, all of our time openings, we were below here. So that alone was also telling us price was in discount based on time alone. Okay. So from there, once again, you can go down to the lower time frames more to break it down, but we move back to the upside. We hit our weekly open going into Friday. And then what are we thinking of here now? We're hitting our draw on liquidity. We're hitting the standard deviation back to the upside. We're seeing SMT form here. So what are they giving now? The retrace down to close the weekly candle. So I'm thinking in terms of this here. So right here was our one. Okay, that's a very badly drawn one. Don't make fun of me. Or do, I don't give a shit. 1, 2, 3, and then now 4 right here. Right here is where the weekly candle closed, okay? So 1, 2, 3, 4. I mean, it can't get much more simpler than this, because then when you're using the other tools that I am giving you here, man, it's all you're ever going to need. It's the only thing you're going to want to trade because it has the most logic and framework behind it. I can explain and understand every move that is happening within this power of three, and how if you were following me on Twitter, I understood that there was a reversal coming on Friday before Friday even happened. Okay. Power of three sets the stage and shows you what is happening before it happens. And this is also why I say news like this is planned in the chart ahead of time, because now I'm going to go over one more example here on the higher time frame, and then we're going to be getting into the lower time frame, the bread and butter. So once again here now, we're thinking in terms of our new weekly power of three. We're going in, we have a new weekly open. Okay. And once again, the same thing as the previous week, they give bearish news. Okay. Except this week it was tariffs. Okay. Every week, every month, it's always going to be something different. They're going to use something to bait people into one direction, to use it as manipulation to go the opposite. It's a classic move. It's what they always do. The market is very manipulated. So just like last week, we're projecting that high just before the new week because we displaced below that low, key spot within the standard deviation and SMT. We're projecting that back to the downside. So once again here, that Friday manipulation, because look at this. If we extend this weekly open out more, it gives even more logic for the framework of what I'm projecting here, that weekly open manipulation. All right. So here on Friday, though, they went ahead and displaced it back below this low. So I already knew going into the new week, I said I was anticipating a gap down and just more downside throughout this swing. I was anticipating this swing to play out because it was also very high probability, because look at what our key spots align with. 2 to 2.5 right on that yearly open right there. That is high probability. That is high probability to see that referred back to and can be used as a target along the way if you were short. But in this case, they opened us below it. They gave us a massive gap down just like the previous week. And once again here, bearish news. So wouldn't you say that the tariff news was more bearish than the deep seek news we saw the week before? Because I mean, I would say it was. Anyone logical would say it was. And so explain to me this: if buyers and sellers are what move this market, why is it deep seek news dropped 1,000 points, but then here for tariff news, they open it and drop it, what was this, 300 points, and then the low was in? How could I have known that? How could I have called that? Well, one, we had our higher time frame levels here that I gave on Twitter. Two, we're hitting 3.5 to 4 standard deviations where we typically see the range cap. All right. And 4, double SMT. Okay. We have a higher time frame and a lower time frame SMT here. It was very high probability. I was very confident in this reversal back up because once again here at the lows, I'm thinking in terms of weekly power of three and that weekly candle. What has happened so far? And here at the lows, this was the current weekly candle. Just a big red candle, no wick above, and then a small wick below. Okay. Once again, it's high probability to see that other side referred back to if we don't have a wick. And once again, they take it down, key spot within the standard deviation, SMT, and then up from there, because I'm thinking in terms of 1, 2, 3, 4 again. So right here, we had our 1, 2, which is the low. And I gave you all the framework for why that was the low and why it formed there. And then from there, they rally it the rest of the week. We get above the gap, used it as support, and then come up here and we form the high. Once again, on what day? Friday. No different than last week as we're going into the new week. All right. Friday, they displace it below the low again to come back down here and close this weekly candle. Okay. Same thing. And once again, this was non-farm payroll and that manipulation. You can project it back to the downside. Look at this. The gap down they give, once again, right into where? 2 to 2.5 standard deviations. And that was the low of last week, okay? I don't know how many times I have to explain and show this to people before they'll actually want to dig in to this themselves. I mean, it doesn't matter to me if you do or don't. I'm just trying to show you the logic and precision behind it to help you, because I know now more than ever that it will. So here was our higher time frame examples. And once again, this was breaking down our weekly power of 3 in a weekly candle down to the lower time frames here. So now we're going to be focusing with 4-hour candles and breaking those down to our lower time frame charts like 15, 5, and 1 minute. So let's get into that. All right, so here we're going to be breaking down these lower time frame examples, and more specifically breaking down a 4-hour candle down to the lower time frames that I am trading. Okay, and just how I'm going about that and all of that good stuff. So here is we're going into the day. So we're specifically looking at this day here after midnight price, okay? Because after midnight is when the true price action starts, because midnight is the true daily opening, okay? So this is the true open of the daily candle. All right. And based off, this is that swing I'm using to the downside here. This is our manipulation of midnight price. And before we get into it, I'm actually going to be using market replay for this example just to show you the current 4-hour candle. So it's going to bring up these indicators I have here to mark out the midnight price and our current power of 3 openings. All right. So this is the only reason I'm going to be using the market replay here. So I traded this, and once again, I like using these recent examples in price so you can see what is happening, and because you likely watched or traded this price action. So you're going to know what you were thinking, your logic behind it, and how you're able to adjust or fix it to see what is actually happening here within price. So here as we're going into the morning, I'm only trading between 2 time periods, and that is 1:30 to 4:30 a.m. and 7:30 to 10:30 a.m. Okay. If you want to know more about that and why, you can join the Discord, but those are the 2 time frames I trade between. And here, going into the morning, I was looking to trade between that 7:30 to 10:30 a.m. I was specifically looking at that 10 a.m. price because I wanted to trade the new 4-hour candle. Okay. And I'm going to be explaining more of why I wanted to wait for that right here. So here, as we're going into the morning, I'm looking at what happened through the night, all of our projections, all of our manipulations of our key time openings to see where we are at within our current power of 3. And here I noticed to the downside, we're hitting our 2 to 2.5 standard deviations from the previous, or the high of day of the previous day. And then going into the day, we're seeing our 2 to 2.5 standard deviations hit from the manipulation of midnight price. Okay. We're also hitting our standard deviations from the current manipulation of this 4-hour opening. So from here, as we're hitting all of our standard deviations down here, there's no reason to be bearish here. We're seeing SMT and all of our good stuff that aligned here. So to me, there was nothing indicating to be bearish here, especially when we're hitting our standard deviations to the downside. Forming, or when we're moving to the downside and hitting our key spots, if you're starting to turn bearish there, then we're definitely forming a low there. That's how the liquidity works and how the standard deviation works. They want you to think certain ways, and that's how they build liquidity through retail. Because once again, right here, it looks like obvious support was built right here just for them to slam it through. And when they do that, they're making everyone that was buying this big support stop out for a loss of their longs, and then they're tripping lots of people in short here on this move down. And to me, this was a great last manipulation leg down, because I'm looking at price in terms of accumulation. Now they're giving the manipulation to distribute it right back to the highs, okay? Because they're using midnight as resistance here. It looks like big resistance is at midnight price. And with that, we're going to see a rally through it because people are shorting, putting their stop losses above it. And now we're in sync with the higher time frame, because the higher time frame is bullish. So we want to be trying to trade and look for setups in that direction. So here, I'm projecting this leg back to the upside because this was that current 4-hour opens manipulation. You can see the opening price here. Here was that high we formed and formed the low. This was our manipulation of that current 4-hour opening. All right. So now I was already anticipating bullish prices as we're going into this next 4-hour candle, but there was nothing for me to trade yet. So this was my idea. I was looking at price as this was the sell side of the curve. So from here, every move lower, we're moving to our standard deviation. Every move above or to the upside above an old high would be a false market structure shift and or a turtle soup to go lower until we hit our draw. Okay. And then once we hit our draw, which we did here, now we've started the buy side of the curve. Okay. So from here, whenever I anticipate the buy side of the curve to start, I anticipate that low to be a protected low. I don't want to see this low taken out. I anticipate this to stay the low right now and be a safe low as we go into our new 4-hour candle, which is the 10 a.m. opening. And this is where I was interested to trade, because look at this. So they take it above midnight price and above the breaker, but right here on this move, they closed it above this candle, which created the breaker. This moved back down. We came back, tapped the breaker, damn near perfect, and up from there. Where to? 2 to 2.5 standard deviations. So let's break this down even more to where I traded it. All right, so here I got it to replay. So now, once again, we're looking at this data candles high and low because we're anticipating it to be a range. And I brought up the ES here, as you can see now. And it's very important that we're always watching both, because it's going to show you where the market tips its hand to you. And what I mean by that is, think of it as you're playing a card game. This is when the market is tipping its hand to you and showing you its cards. So you're going to know the market's cards and what it's going to do, how it wants to deal these cards, okay? And let me explain more into that. So right here, let me play a few more candles on the NQ. This wick right here, so you can see on the NQ, as we were coming up short of taking out this data low, let's look at the ES. The ES at that same time was already below the data low. So right there, to me, that was the market tipping its hand to me and showing us that we are about to expand back to the upside. Because think of what I said about the sell side of the curve. So on the sell side of the curve, all these moves above these old highs were false market structure shifts and or turtle soups for them to drop it back down. So now for the buy side of the curve, it's the opposite. Any moves below old lows will be false market structure shifts and or turtle soups to go higher, okay? And all of this will be taking place without us taking out this low down here, because we anticipate this to be our protected low. So then going into here, the ES coming up short or the NQ coming up short, the ES makes a new low. Right there, the market tipped its hand to me. That is where I went long on the NQ, because not only that were we seeing that SMT, we're manipulating below the current 4-hour open here. So once again, I'm thinking in terms of open, we're forming the low now. Now I want to see us go up and form the high, okay? And where should that take place at? We already know our 2 to 2.5 standard deviation up here. The standard deviation is already telling us where the market is drawing to. So once again, from here, you can go back and watch my trade review. That is where I went long, take profit, data high, and then 2 standard deviations, okay? So there, right there is where I was out of my long, because we're hitting everything that we needed to, our standard deviations to the upside. And this also plays into now what I was playing here within the candle. So I played that move. So if we're thinking in terms of 1, 2, 3, 4, I played the move from 1 to 2. Okay. So once again, let's mark it out here and show you. Let me go back to the 1 minute. I think we'll be able to see it more clearly here. And I'll full screen the NASDAQ chart. So once again, I'm thinking in terms of 1, 2, 3, 4. So we had the opening price here. All right. So this was our 1. Okay. So then at that time, I was thinking this was our 2. We're forming the low. And then we wanted to move up and hit our standard deviation. And we did exactly that. So I played this move. So you can look at it as the move from 2 to 3. Or if we zoom out more and notice that this is still early within our candle. When we zoom out, this was really the move from 1 to 2, because let me remove this number 2 drawing here to show you that this was really the opening, and right here was the accumulation for us to form the manipulation to the upside, where we do what? We hit our key spot within the standard deviation, we form our SMT, and then we flip back over, because this was the projection back to the downside. This was a 15-minute swing. You can go up to those higher time frames and go look if you don't believe me, but this was that swing I was projecting back to the downside. So from here, I was thinking 1, 2, and this is where I sold out. I was out here. I played the manipulation of this candle, okay? And you can do that, but you got to remember though, it's not going to be the meat of the move, okay? So you're not always going to get the meat of the move, okay? But that is typically what we are aiming for. And 1, 2, 3, and then they're coming back up to close the candle now to create that wick. So once again, opening price, we moved up, created the high inside our key spot within the standard deviation, SMT, displace it below this low. There's our valid projection back down, and then right down to 2 to 2.5 standard deviations, where we're doing what? Forming the low of the candle once again, and they retrace it up and close the 4-hour candle, because once again, they want to get that last retrace up to create the wick of that candle, that bottom wick on this 4-hour candle. So always be thinking in terms of where are we at within our higher time frame candle breakdown, because it's going to help you a lot within choosing targets for if you should hold a position, if you should take profits, all of the logic that you're probably missing inside your trading. All right, welcome to another example. So this one is actually with data in the morning. Okay, so we had 8:30 data, which was CPI. So we were anticipating a big move to happen here, and I'm just going to be going through showing you here exactly how news is very readable and how it's planned in the charts ahead of time. So before the CPI report even came out, I had said this the day before, that I thought CPI was going to take us down. But then I said it again this morning whenever I saw the overnight price action, because let's look here. So once again, we're going into the morning. I'm looking at what happened through the night, and overall through the night, there was a lot of nothing, just accumulation down here. We were just building up liquidity for us to come back through these lows, to me, because there was no bullish SMT. We hadn't hit any of our key spots to the standard deviation to the downside. So to me, I was looking at this manipulation below midnight price to project it back up. And we were hitting our 2 to 2.5 standard deviations here and taking out this buy side liquidity. And this was very important because one, it was equal highs on NQ, and two, that was the previous day's high on ES. You can see that previous day, this was the high. If we look at the NQ that previous day, this high before that high on the ES was the high of day. So they were offset at the highs. We had that higher time frame SMT already. This was the lower time frame SMT. So right here, as we were going into the 8:30 data report, we were seeing our SMT again at our key spot within the standard deviation from that current power of 3, which was the daily power of 3, because we're projecting the manipulation of midnight price. So then here, we're anticipating this 4-hour range to be capping here, because once again, now I'm thinking we went from daily power of 3, now we're breaking it down to 4-hour power of 3. And to me, I'm seeing them both pretty much the same way. The daily power of 3, we had our opening price here, okay, the midnight opening. Now this 4-hour candle, we had our opening price right here. So we have both of our one scenarios right here, our opening prices. Now, from here, we moved up, we're hitting our standard deviation, we're taking out our liquidity, we're seeing our double SMT. That's everything we need to anticipate a high to be forming here. So we have number 2 for both scenarios here, okay? Our daily high and our 4-hour high. So then from here, we're anticipating what now? A low. So we want to see an expansion down. And that's exactly what happens here with CPI data. So then you can see the ES came up short of that high again to leave what? That SMT. That's why the ES came up short of that high. So we can see we get a very nice expansion to the downside. And with that, whenever I go up to the hourly chart here, it was much more clear to me. We had a much better swing to project to the downside, okay? This high to low here. And you can see we went right down to it. So this right here is everything that's playing into how I'm analyzing the market, how I'm breaking down a higher time frame candle down to these lower time frames. Because then what do we have down here? Our number 3, and then they're coming back up for what? Number 4 to close the candle. Okay, it's always happening like this. Once again, it can happen 2 ways and 2 ways only: open low high close, or the opposite, open high low close. And it's never going to stop. Once again, I'm using these recent examples here in price showing you, but go back to years ago and go study and show me if it was working, because I know it was. But yeah, I mean, I hope you all got something from this video. I've been wanting to put this video out for a minute, but I said before, I had the video pretty much done, and then my PC took a crap on me and I lost all of my files. So here we are back with it, and here I am releasing it. So I hope you all got something from this, and I really hope to see more people breaking the market down like this, because I know all of my Discord is doing it just like me, and there's many people calling the moves before they even happen, just like I am. Because with the standard deviation and SMT, more specifically, standard deviation plus SMT theory brings you the logic that you're missing in your trading. So until I talk to you all again, I hope you all have a good one.